Chapter 14, Long-Term Liabilities. Some notes payable are due during the current operating cycle. Such notes are classified as current liabilities. Notes that are due at any time after the current operating cycle, or 1 year, whichever is longer, are classified as long-term notes payable. In each year, the portion of any long-term notes payable that is due in the current year is taken out of long-term notes payable using a debit and reclassified as a current note payable using a credit. Initially, all notes payable are recorded at the amount borrowed. A note payable is recorded on the date of the borrowing. Once time has passed and the company has had time to accumulate some owed interest, then interest is accrued, as we did in Chapter 3 with accrued liabilities. Suppose that on December 31st, 2014, Smart Touch Learning signed a $20,000 note payable. It is due in 4 annual payments of $5,000 plus 6% interest each December 31st. Going forward, payments are due on 12/31/15, 12/31/16, 12/31/17, and 12/31/18. Prepare the journal entry to record the borrowing. Well, this is what that would look like. For the borrowing, you would just record a debit of $20,000 cash because you're receiving that, and a credit of notes payable for $20,000. At this point, the moment that the note payable is in effect, there is no interest accumulated. When the time is appropriate, we will need to compute and record interest expense and interest payable. The formula is beginning balance times interest rate times time. Beginning balance in notes payable equals the unpaid balance of the original borrowed amount. Interest rate equals the stated interest rate on the note. Interest is always stated as an annual rate, even if the interest period itself is less than a year. Time equals the fraction of a year that covers the interest period. Generally, we will break the year down into either days, months, or quarters. Going back to the note that Smart Touch Learning borrowed on December 31st, 2014, remember that the principal borrowed was $20,000. The note called for an annual interest rate of 6%. Compute the amount of interest owed at December 31st, 2015. Well, we multiply the principal of $20,000 by the interest rate of 6%. And then we multiply the time times 1 because we're talking about 1 full year. So the interest to be recorded for this period is $1,200. We can pre-compute the amount of interest that we will need to record each period and the amount of interest expense that we will need to record. We can put all of the information in a spreadsheet referred to as an interest amortization table. Here we see that on December 31st, 2015, we will need to record a payment of $6,200. This all comes out of cash. However, $5,000 will be debited to notes payable account, and the other $1,200 will be debited to interest expense. Enter the entry to record the principal and interest paid. This is what that would look like. A debit to notes payable for $5,000, a debit to interest expense for $1,200 as previously discussed, and of course, if you're paying with cash, the credit will be to cash for $6,200. Here's another try to take a look at. And here's what the answer would look like. And another try it. And the answer to that one. In addition to long-term loans, companies can also create debt by issuing bonds. Bonds are long-term debt issued to multiple lenders usually in $1,000 increments. The bonds have a contractual interest rate associated with them and also have a market value based on the relationship between the contract interest rate on the bond and the market interest rate available in the marketplace. A bond is often a very ornate document, as we saw also with the stock certificates. Again, this is to help discourage counterfeiting. The document will have some key features that make it marketable, meaning the company can sell it on the open financial market to interested buyers. The critical components are the name of the issuing company, the date the bond was issued, the date the bond matures, the face value of the bond, and the contractual interest rate of the bond. Let's go back one real quick here. Oh, skipped too far ahead. Sorry about that, some technical difficulties there. Okay, here's where we left off. Some bonds are secured, which means that they are linked to specific collateral. For example, if a company issues secure bonds to build a new office building, then if the bonds are not paid, the bondholders have a first right to take the building as a settlement of the amount owed. Unsecured bonds are referred to as debentures. Most bonds today are unsecured. There is also a distinction between term bonds and serial bonds. Most bonds are term bonds, which means that the money is borrowed from the investor at the inception of the bond issue. During the bond term, the company will pay interest on the outstanding amount of the bond, its face value, and at the end of the bond maturity period, the original borrowed amount is returned to the investor. Now, a serial bond is a bond that requires periodic payments that include an amount to reduce the principal in addition to paying interest. Installment loans behave the same way as serial bonds. How much a company can get for its bonds will depend on the relationship between the stated rate of interest on the bond contract, which is locked in, and the market rate of interest, which changes and fluctuates over time. When the stated rate on the bond equals the market rate that can be had in the marketplace, the company will be able to sell its bonds for their face value. Now, when the stated rate on the bond is less than the interest rate you could get in the marketplace, the company will have to sell its bonds at a discount from their face value, which basically means you'll end up paying the same amount of interest as if you borrowed the full face value of the bond, but you'll actually get less money for it. Now, when the stated rate is greater than the market rate, then the company will be able to sell its bonds at a premium over their face value. So let's say they're selling $20,000 worth of bonds at a premium. Instead of loaning the company $20,000, an investor would have to loan them, let's say, $20,500 to make up for the difference in the current market rate of interest in the marketplace. Any discounts or premiums that are generated must be accounted for. They will be amortized over the life of the bond, and the amortization will increase interest expense if there's a discount, or decrease interest expense if there's a premium. So take a look at this triad. Smart Touch Learning issues bonds on January 1st, 2014. The bonds have a face value of $100,000 and carry a stated interest rate of 9%. The market rate of interest at the time is also 9%. These bonds will therefore be issued at face value. Record the issuance of the bonds. Well, we'll just have a debit to cash for the amount that we're borrowing, which is $100,000, and a credit to bonds payable for that amount. Sometimes the stated rate is less than the market rate. In these cases, the bonds are sold at a discount from their face value. The resulting bond discount will be recorded as a contra liability account. Interest expense each period will be sum of the computed interest payment and the portion of the discount that is amortized that period. So take a look at this example. Smart Touch Learning issues $100,000 of 9% 5-year bonds that pay interest semi-annually. The market rate of interest is 10%. Smart Touch Learning will actually receive only $96,149 for the bonds. The discount of $3,851 will be recorded as a bond discount. Record the issuance of the bonds. The journal entry will require a debit to cash for $96,149, a credit to bonds payable for $100,000 because that's the amount that we will owe in principal at the end of the bond term, and a debit to discount on bonds payable for $3,851. The discount amortization table shown here shows the computation of interest expense over the course of the bond's life. There will be 10 interest periods, 2 per year. Each period will see an interest payment of $4,500, which is $100,000, the face value of the bond, times 9% times 6 out of 12, or 1/2 of the year. In addition, we will amortize the $3,851 discount using a straight line approach, so basically just dividing that amount by 10 equal payments, giving us $385 per period. Of course, in that case, the last period, the discount amortization is $386 to account for previous rounding differences. Total interest expense in each period is $4,885, which is the sum of the amount paid to the bondholder, $4,500, and the amount amortized. So basically, you are taking the discount that you had to sell the bonds at and dividing that up and basically apportioning that each period as if you had actually gone in and changed the interest rate on the bond. So effectively, that's what you're doing. You're recording the interest expense as if you'd paid the actual market rate of interest on the bond during that time period. Record Smart Touch Learning's first interest payment on June 30, 2014. Well, as you can see here, you'll have a debit to interest expense. This will be the total amount between the cash you pay and the discount on the bonds payable. So this will be $4,885 debit, credit for cash $4,500. This is the amount you're actually paying in interest, and then the $385 amortized discount on bonds payable. At maturity on December 31st, 2018, all the interest has been paid and the discount on bonds payable has been fully amortized. At this point, bonds payable net equals $100,000. Record the retirement of the bonds. This is a simple retirement of any type of debt that you have. You basically enter the debit amount into the liability account of bonds payable. That cancels out your bond payable amount that you had on the books. So you no longer have any liability under bonds payable for this transaction, and we show a credit to cash of $100,000 showing that we paid this amount. In many cases, the company has the right to retire the bonds before maturity. When that occurs, the bonds will be paid off based on their current book value and any penalties that must be recorded by contract. As a result, there will usually be the need to record either a gain on the retirement of bonds or a loss on the retirement of bonds. On December 31st, 2014, after only 2 interest payments, Smart Touch Learning decides to pay off or retire the bonds. They are required to pay $95,000. At this point, the discount on bonds payable is showing a balance of $3,081. The bonds payable has a balance of $100,000. Record this early retirement of the bonds. Well, this is what that would look like. The entry will require that the bonds be removed from the books by recording a debit to bonds payable of $100,000 and a credit to the remaining discount on bonds payable of $3,081. In addition, cash will be credited for $95,000. In order to balance the journal entry, a gain on retirement of bonds will need to be recorded with a credit of $1,919. In this try it, go ahead and take a look at the question, and then I'll show you the answer in a minute. Long-term liabilities are grouped together in the liabilities section of the balance sheet and are presented after the current liabilities. They are shown net of any discounts or premiums. The debt-to-equity ratio is a measure of the proportion of liabilities to equities, called financial leverage. A debt-to-equity ratio greater than 1 indicates that the company is funding more assets with debt than equity. This also indicates a higher level of financial risk for the company. The ratio is calculated as total liabilities divided by total equity. Using the information for Green Mountain Coffee Roasters, calculate the debt-to-equity ratio for 2011. Debt-to-equity ratio equals, again, total liabilities divided by total equity, or in this case, 1,285,672 divided by 1,912,215, or a debt-to-equity ratio rounded to the nearest hundredth of 0.67. Take a look at this try it. And that is the end of this chapter.